If you had told me last week that the global financial system, specifically the multi-billion-dollar silver market, would be brought to its knees because of a real estate dispute over a frozen island in the North Atlantic, I would have told you to check your medication. I would have said you were watching too many conspiracy movies. But here we are. It is Sunday, January 18th, 2026, and the rules of the game have just been rewritten. Right now, the mainstream media is having a field day. They are laughing. They are running segments featuring outraged Danish politicians and making jokes about President Trump trying to buy Greenland. Again, they treat it like a circus. But while the pundits are laughing, the risk managers at JP Morgan, HSBC, and the major bullion banks are screaming. Why? Because buried in that headline, hidden behind the political theater of buying an island, is a policy shift that acts as a nuclear bomb for the global precious metals supply chain. This isn't about ice sheets. This is about a single sentence in a tweet that has effectively severed the logistical artery between New York and London. We are looking at a 10% tariff that doesn't just tax goods, it traps capital. And for the silver market, which is already bleeding dry from a silent war with China, this might be the final nail in the coffin. Today, we are going to explain why your silver stack just got caught in a geopolitical vice, and why the law of one price has been repealed by executive order. Let's strip away the noise and look at the hard data. President Trump has announced a blanket 10% tariff on all imports from 8 European nations, explicitly including the United Kingdom, effective February 1st. The ultimatum is clear. If a deal for Greenland isn't reached, that tariff spikes to 25% on June 1st. To the average person, this looks like a standard trade dispute, a negotiating tactic. But to the algorithm trading futures in Chicago and to the vault operators in London, this is a logistical nightmare. To understand why, you have to understand how the game of silver is played. The entire global pricing mechanism relies on one thing: fungibility. The market assumes that a 1000 ounce bar of silver sitting in a London vault is identical to a 1000 ounce bar sitting in a New York vault. But more importantly, it assumes you can move them back and forth cheaply. This is the whack-a-mole game that bullion banks have played for decades. When the price spikes in New York, banks fly metal in from London to flood the market and crush the premium. When London runs dry, which is exactly what has been happening lately, they fly metal from New York to refill the shelves. This oceanic shuttle run is the only thing keeping the global spot price stable. It's the lifeline of price suppression. But what happens when you erect a 10% tariff wall in the middle of the Atlantic Ocean? The United Kingdom is on the list. The LBMA, London Bullion Market Association, is in the UK. This means that starting February 1st, if a US bank ships silver to London to bail out a short squeeze and then tries to bring that metal back to the US later, they get hit with a 10% tax on the total value at $90 an ounce. That is a $9 penalty per ounce in the razor-thin margin world of high-frequency trading and bullion banking. A 10% hit isn't a loss, it's an insolvency event. It destroys the arbitrage. It makes the whack-a-mole game mathematically impossible. This brings us to a concept in commodity trading that is about to become your reality: the Roach Motel effect. You know the old slogan, roaches check in, but they don't check out. Well, thanks to this tariff, silver can check into the United States, but it cannot check out. Picture the situation in the risk management department of a major bank this Sunday morning. They see London is desperate for metal. Normally, they would issue an export order to ship 1 million ounces from the COMEX in New York to the LBMA in London. It's an easy trade, but now, the spreadsheet turns red. If they send that metal to London, it leaves the US jurisdiction. If they ever need to bring it back to settle a contract in New York, they have to pay the US government $9 million in tariffs on a $90 million shipment. That wipes out the profit 10 times over. So, the order is canceled. The stop-move command is issued. President Trump has inadvertently turned the US border into a one-way valve. Metal can flow in from non-tariff nations like Mexico, but it cannot leave for London. If it leaves, it is financially destroyed. This creates a trapped inventory scenario. The 4.2 million ounces we saw withdrawn from the COMEX on Friday, we thought that was heading to London or China. Now, it's likely stuck at JFK Airport, wrapped in plastic, with nowhere to go, The owners aren't going to ship it if they can't bring it back. This is bullish for the U.S. supply in the short term, but it is catastrophic for the global pricing mechanism. We are about to witness the bifurcation of the West. We might see silver trading at $90 in New York, but screaming up to $110 or $120 in London simply because the metal cannot physically move to close the gap. The arbitrage bots are going to malfunction on Monday morning because their code doesn't account for a trade war over an ice sheet. Now, let's zoom out. We need to look at who actually wins here, because in geopolitics, there are no accidents, only consequences. For the last 3 years, we have covered the Shanghai vacuum. We've watched China and India relentlessly drain the West of physical gold and silver. They have been using the suppressed paper price in London to buy real metal at a discount. London has been the buffet, and Asia has been feasting. This Greenland Tariff, whether intentional or accidental, puts a hard stop to that. By making it too expensive to export silver from the US to the UK, the administration has effectively created a domestic strategic reserve. Think about it. The US Mint has been running out of blanks. Strategic industries like Tesla, Raytheon, and Lockheed Martin need silver for EVs and missiles. In a world of fragmenting supply chains, why would the United States allow its precious silver reserves to be flown to London, only to be sold to China? It wouldn't. This tariff forces the banks to become preppers. It forces them to hoard metal domestically. It tells London, you are on your own. You cannot raid our vaults to save your exchange anymore. This is America First applied to the periodic table. It secures the physical inventory for U.S. industry and U.S. defense while leaving Europe and the U.K. to face the music. And the music in London is stopping. The banks in New York will circle the wagons. They will choose to protect the COMEX because they are U.S. domiciled entities. They will let London burn to save New York. This is the ruthlessness of the new economic paradigm. The globalized frictionless trade of the last 30 years is over. We are entering an era of walls, tariffs, and resource nationalism. So what is the fate of London? The LBMA is facing a solvency crisis. Their vaults are critically short on metal, and the lifeline from New York has just been cut. Monday morning brings the real risk of a physical default. If you hold unallocated silver, essentially a paper IOU, you are in the danger zone. When the market realizes no fresh supply is coming, premiums will skyrocket, violently disconnecting the real street price from the paper price. But the ultimate danger is a derivative implosion. Banks rely on global hedges, balancing positions between New York and London. With the logistical link severed, those hedges break. Banks trapped in short positions can no longer ship metal to cover them. They will be forced to panic buy at any price to close their books. London is now a financial island. And as the West freezes, the sharks in Shanghai smell blood, ready to drain the last drops of liquidity from a broken system. We are watching the balkanization of the financial world. This tariff is a black swan event that has exposed the fragility of a system built on paper promises. Here's the new reality for the investor. Geographic diversification is dead. Possession is now 9/10 of the law. You do not want your metal stranded on the wrong side of a tariff wall. The spot price is a lie. It is now just an average of 2 broken markets. Do not value your stack based on a screen number that ignores the true cost of replacement. The game is rigged. By trapping silver domestically, the U.S. government has inadvertently put a floor under the price. The banks can no longer suppress it by shuffling paper across the ocean. Expect chaos this week. The logistics are broken, the bridge is out, and the bankers are finally trapped. Hold your position. In a world of paper illusions, the only thing that matters is what you can hold in your hand. Subscribe to stay ahead of the curve. See you on the other side of the opening bell.
December 29, 2025. Remember this date. While the world was sleeping, the global financial architecture just suffered a catastrophic breach. Silver hasn't just broken the glass ceiling of $50, it has detonated, screaming past $80 an ounce in a vertical climb that is currently bankrupting the world's most powerful bullion banks. But here is the terrifying reality that the mainstream media is refusing to cover. This isn't just a price spike, it is a silver blockade. In exactly 48 hours, China will pull the kill switch on global exports, effectively holding the Western world's high-tech industry hostage. At the same time, a classified U.S. executive order has just transformed this jewelry metal into a weapon of national security. The smart money is already vanishing into the bunkers, while retail investors are being fed a lie that this is just a speculative bubble. Tonight, we went inside the war room. We're revealing the hidden connection between the AI explosion, the secret U.S.-China mining war, and why the silver in your hand might soon be more valuable than the cash in your bank. If you think you're too late, you're wrong. The real squeeze hasn't even begun yet. Stay with me for the next 10 minutes or risk being left behind in the greatest wealth transfer of the 21st century.
To truly understand the carnage we're seeing on the charts, we have to look at the scoreboard of the Great Reset. For decades, silver was treated as gold's poor cousin, a volatile, often ignored metal relegated to the jewelry boxes of the middle class and the dusty shelves of industrial warehouses. But 2025 has shattered that narrative forever. This is the year silver finally stepped out of the shadows and went nuclear. While gold has delivered a respectable 70% gain, the kind of performance that would normally define a decade, silver has surged over 150% year-to-date. But don't be fooled, this isn't just a meme rally or speculative fever. We are witnessing a fundamental repricing of reality. Two massive tectonic shifts have occurred this quarter, and they have permanently altered the DNA of the global financial system. First, the U.S. strategic pivot. In a historic move, the Trump administration officially reclassified silver as a critical mineral. For the first time in American history, silver is no longer just a precious metal for jewelry, it is now legally designated as essential to national security, putting it on par with lithium and uranium. This allows the government to bypass environmental regulations and fast-track mining. But more importantly, it signals that the U.S. is terrified of losing access to the supply. Second, the China export licensing bombshell. Simultaneously, Beijing dropped a geopolitical grenade. Starting January 1, 2026, just 2 days from now, China will implement a strict government licensing regime for all silver exports. China is the world's manufacturing hub for the very technologies that breathe silver: solar panels, EVs, and high-end semiconductors. By locking down supply, Beijing isn't just raising prices, they are building a wall around the future. This is no longer a market, it is a blockade. Let's perform a forensic analysis on why this is a short squeeze for the history books. For 5 straight years, the global silver market has been in a structural deficit. We have been living on borrowed time and dwindling inventories. This is the weaponization of conductance. In the 20th century, we fought wars over oil. In the 21st, we will fight over silver. Every NVIDIA H100 chip, every Tesla battery, and every solar farm in the Mojave Desert requires silver. Its electrical conductivity is irreplaceable. There is no plan B. China knows this. By controlling the refining and export of silver, they have effectively gained a kill switch over the West's green transition. If you want to build a solar grid in Europe or an EV fleet in the US, you now have to ask Beijing for permission. This is resource nationalism at its most lethal. Behind the scenes at the COMEX, the smart money, the massive bullion banks, have been caught in a liquidity trap. For years, they held massive short positions, betting that silver would never break the $30 to $50 range. They used paper silver to suppress the price, trading ounces that didn't exist to keep the illusion of abundance alive. But you cannot suppress a physical shortage with paper forever. When the U.S. declared silver a strategic asset, the game ended. Sovereign wealth funds from the Middle East to Singapore began demanding physical delivery. The result? A liquidity squeeze that is forcing the shorts to buy back silver at any price to avoid total bankruptcy. This is why the price action is parabolic. We aren't seeing a rally, we are seeing a default of the old paper system. Look at the AI connection. We're told AI is the future, but AI runs on hardware, and hardware runs on silver.
As data centers expand globally, the demand for high-performance silver-backed circuitry is exploding. We are witnessing a collision between the digital world and physical reality. The tech giants are starting to realize that all the software in the world won't save them if they can't get the physical metal to build the servers. What's truly shocking is the mining paradox. Even with silver at $80, many mining stocks are only just starting to wake up. Investors are paralyzed by fear, thinking this is a fluke, but the whales know better. They are accumulating the producers because they know that at $80 silver, these companies are no longer mining metal. They are mining pure, unadulterated cash flow. The delay in the mining stocks is the last gift the market will give you before the total repricing occurs. As we head into the final hours of 2025, the board is set. On one side, we have the U.S. scrambling to build a domestic supply chain for a metal it has ignored for a century. On the other, we have China, which has spent the last decade quietly cornering the market and is now ready to turn off the faucet. This is the great catch-up. The gold-to-silver ratio is collapsing, and the retail crowd is still focused on overhyped tech stocks, while the very materials needed to build those technologies are disappearing from the vaults. The next 2 weeks will be a war zone for the markets. With China's export ban taking effect in 48 hours, the physical market is about to enter a vacuum. History shows us that when a strategic commodity goes into a squeeze, the price doesn't just go up, it teleports. We saw it with nickel, we saw it with lithium, and now it's silver's turn. The question for you is simple. When the history books look back at the great silver squeeze of 2026, will you be one of the few who followed the smart money into the vault? Or will you be left holding a handful of paper in a world that only values the physical? The clock is ticking. The blockade begins in 48 hours. Don't say we didn't warn you. What do you think? Is $100 silver inevitable by February, or is the empire about to strike back with even more manipulation? Let us know in the comments. We'll see you in the next investigation. There's a saying in the intelligence community, don't look at where the bomb went off. Look at where the getaway car is speeding away. In financial markets, we are conditioned to look for noise. We fixate on the massive red candles when the Fed hikes rates. We obsess over headlines screaming about economic collapse or the chaos of the midterm elections. But right now, if you mute the TV and look at the S&P 500 weekly chart, you see something strange. You see boredom. The price churns. It rips up, slams down, and returns to nowhere. To the average retail trader, this looks like a dead zone. They call it a bear market. They're exhausted. They're checking their accounts less and less. And that is exactly the point. Boredom is the ultimate weapon of the institution. They bore you to death before they squeeze you to death. If you peel back the layer of apathy and look at the flow data, you see a completely different story. You see a war zone. Billions of dollars are being silently injected into this market through massive limit buy orders via dark pools. Someone is standing at the gates of hell. Someone is absorbing the entire panic of the crowd without flinching. We are not witnessing a crash. We are witnessing the loading phase, and you need to be on the same side as the loader. To understand what is happening, you have to understand how smart money hunts. If you are a massive pension fund or a Wall Street giant, you don't buy when the sky is clear. You buy when the crowd is distracted by political theater. Let's turn on forensic analysis. The data from MarketWatch isn't just statistics, it is a crime scene footprint. Since 1942, through world wars, inflation, the dot-com bubble, and the 2008 crisis, there is one rule that has never been broken. The year 3 effect. Look at 2010, look at 2014, look at 2018. In every single instance, the second year of a term was a bloodbath of volatility. Why? Because of uncertainty. Wall Street hates uncertainty more than bad news. They pull capital, creating a liquidity vacuum where price swings violently. But here is the detail the mainstream media misses. Wall Street has a cruel nickname for this specific setup, the pain trade. The market always moves in the direction that causes the maximum amount of financial misery to the maximum number of people. Right now, look at the sentiment data. Retail traders are holding record levels of cash. Hedge funds are net short. Everyone is hedged. Everyone is expecting a crash. So if the market rips higher, who gets hurt? The shorts get incinerated. The skeptics get left behind on the dock. The algorithm is designed to hunt their liquidity. It feeds on their regret. Watch what happens the second the polls close. In the 12 months following a midterm election, the S&P 500 has a win rate of 100%. I repeat, no exceptions. The whales look at the chart and see a spring compressed to the point of explosion. This flat price action isn't indecision, it is algorithmic accumulation. They are programming bots to buy every time you panic sell. But how does the price physically move up? What is the mechanics of the explosion? We need to talk about the VIX crush. Leading up to the election, everyone buys put options for insurance. This spikes the VIX, volatility index. Dealers on the other side of these trades are forced to short the market to hedge themselves. This creates artificial selling pressure. But the moment the election result is known, the moment the event passes, that insurance is no longer needed. The crowd sells their puts. The VIX crashes. And here is the magic. When the VIX crashes, the dealers are forced by their own risk models to buy back the market. This creates a feedback loop called a Vanna rally. As volatility dies, price rises. As price rises, shorts cover. As shorts cover, price rises more. It becomes a self-fulfilling prophecy of buying power that has nothing to do with fundamentals and everything to do with market plumbing. The silence you see now is just the calm before the VIX implosion. Now, combine that technical explosive with the fundamental trigger, gridlock. Why does political chaos cause the market to explode? The media tries to scare you with the word gridlock, political stalemate. They say the government will be paralyzed, but to the financial elite, government paralysis is nirvana. Think like a CEO of a trillion-dollar empire. What do you fear most? New taxes, new antitrust laws, surprise regulations. When Washington hits gridlock, the legislative gears jam. No new taxes, no surprise laws, total status quo. This triggers the CapEx unleashed phase. For the last 18 months, corporations have been hoarding cash, afraid to invest because they didn't know the rules of the game. But once gridlock is confirmed, that fear evaporates. The board of directors gives the green light. They start building factories. They start buyback programs. They start M&A. We are seeing a rotation from fear assets into growth assets. The smart money is positioning themselves for a 2-year runway of unhindered corporate earnings. It's like driving on a highway, knowing the police have gone to sleep for the next 2 years. What do? You floor it. We are in the final seconds of the accumulation phase. The psychological trap is set. The dips you see in the coming weeks, those are stop hunts, final liquidity sweeps designed to shake the last weak hands off the train. But remember the concept of the price vacuum. When the shorts are forced to cover and the sideline cash chases the rally, this double-engine demand hits a market with zero supply because the whales have locked up the float. This is how you get vertical moves. This is how you get melt-ups that leave rational analysis in the dust. Once the election passes, price doesn't just climb, it teleports. It gaps through resistance zones like they don't even exist. The most dangerous emotion right now isn't fear, it's the temptation to sell too early. When the breakout happens, your brain will scream, "Take the profit," but you are trading pennies in front of a steamroller. The year 3 trend isn't a trade, it's a regime. It lasts for 12 months, not 12 days. What is your strategy? Don't try to fight the whale. Execute the drafting strategy. Place your buy orders right here in the accumulation zone. Place your stop loss right below the concrete floor the whales have built. Don't let the media fool you with headlines about political division. That division is rocket fuel. The whale is fully loaded. The departure signal is flashing. The only question is, when this train leaves the station and hits the vacuum, are you sitting in the seat or are you standing on the platform watching it disappear? On December 5, 2025, Reuters did something that made all of Wall Street hold its breath. They dropped a bombshell article labeling gold's rally as bubble behavior. Their message was crystal clear. Prices have risen too fast, 60%, the highest performance in 46 years. Sell now before it crashes like it did in 1979. According to conventional logic, when this news hit the wires, combined with rising U.S. Treasury yields, gold should have nosedived. Investors should have panic sold to lock in profits. But the unthinkable happened. Gold didn't crash. It didn't even blink. It swallowed that bad news whole and stubbornly continued moving sideways at all-time highs. This isn't resilience. This is a terrifying anomaly. Why would an asset labeled a bubble by the media and being net sold by ETFs refuse to go down? Has the market gone insane? Or is there a shadow force silently scooping up every single ounce the moment it hits the floor? Welcome to Financial News. Let's rewind the tape and dissect this crime scene. We're going to find out why the old laws of supply and demand are dead. Look at the data Reuters accidentally exposed but didn't explain in depth. They call this a bubble. But bubbles are usually driven by retail mania, the euphoria of the crowd. But look at this chart. Gold holdings in ETFs like SPDR are 10% lower than their 2020 peak. Gold miner stocks are still languishing at the bottom. What does this mean? It means the retail crowd, people like you and me, are not buying. In fact, Wall Street is selling. So the billion-dollar question is, who is buying? And how aggressively are they buying to absorb the selling pressure of the entire Western world? The answer lies in the vaults of central banks. According to Goldman Sachs, these whales have been net buyers of over 1,000 tons of gold annually for the last 3 years. But here is the detail the mainstream media ignores. They aren't buying on the public futures exchange, where you can see the volume. They are operating in the opaque over-the-counter markets in London and Switzerland. This is a stealth operation. By keeping their massive buy orders off the public order books, they prevent the price from exploding too early. They are using iceberg orders, buying massive amounts of physical bars while the public price, determined by paper contracts, stays suppressed. Compare this to the China silver dump. When the London market ran out of silver, China had to flush their stockpiles to save the price. But with gold in 2025, the situation is the exact opposite. The West is trying to suppress the price using news and derivatives, paper gold, but the East, China, Russia, India, is standing underneath, catching every single bar of physical metal. This is a reverse squeeze. On the COMEX, for every 1 ounce of registered physical gold, there are now hundreds of paper claims trading against it. It is a game of musical chairs played with dynamite. When the music stops, there won't be enough chairs. They are draining the physical liquidity. Reuters calls it a paradigm shift, but the accurate term is the depletion of Western inventory.
Why are they hoarding so frantically? Why don't they trust the dollar anymore? Let's look at the death spiral mechanism that the article only cautiously hinted at. Reuters compares 2025 to 1979, but this comparison is mathematically flawed. Phase 1, 1979, U.S. debt was only 30% of GDP. Paul Volcker could raise rates to 20% to kill inflation and save the dollar. Phase 2, 2025, U.S. debt is 4 times higher than in 1979. Budget deficits are running at 6% of GDP annually. Here is the deadly trap. If the Fed raises rates to stop gold, the U.S. government goes bankrupt because it can't pay the interest. If the Fed cuts rates to save the government, inflation explodes and gold goes to Mars.
This is no longer just about economics. It is geopolitical warfare. Daniel Oliver from Myrmikan Capital pointed out the exact moment the system broke, the 2022 seizing of Russian reserves. When the U.S. weaponized the dollar, they sent a signal to every sovereign nation: your savings are only yours if we agree with your politics. That shattered the trust that took 80 years to build. You can't print trust. Once it's broken, the flight to safety becomes a permanent migration, not a temporary trade. The Fed's balance sheet is bleeding because it's stuffed with long-term bonds that have lost massive value. Their gold coverage ratio is now only 16% of their liabilities. Think about that. The entity issuing the world's reserve currency is technically insolvent on a mark-to-market basis. Do you see the parallel with the silver market? In silver, it was a physical shortage due to industrial demand, solar. In gold, it is a shortage of trust due to fiscal collapse. The U.S. cannot print more gold. They can only print more dollars. And the central banks know this. They are exchanging paper that is about to lose value for the only real asset left. They aren't buying for profit. They are buying for survival.
So, what is the next scenario? Look at the math, because math doesn't lie. Currently, the gold price is rising solely due to smart money, the whale, buying pressure. The crowd, the retail, hasn't even joined yet because they believe articles like Reuters claiming this is a bubble. And here is the psychological trap. The article wants you to look at the nominal price, $3,000, $3,500, and think it's expensive. But priced in purchasing power, priced in gallons of oil, priced in hours of labor, gold is still cheap. The bubble is in the currency you're holding, not the metal you're watching. But what happens when Western inventory runs dry? Just like silver, when the vaults in London are empty, price will no longer follow any technical analysis. When individual investors realize bonds are no longer safe and stocks are too risky, they will stampede into gold. But at that moment, who will sell to you? The central banks? No, they're buying. The ETFs? They've been net selling for 3 years. Their vaults are emptying. We're facing a supply shock on a global scale. Reuters calls it a paradigm shift. I call it a repricing. Gold isn't rising. The value of currency is free-falling to its true value, zero. Don't let the headlines fool you. They scream bubble to shake the tree, to scare you into selling the little gold you have left. Don't sell your insurance when the world's financial house is on fire. The physical supply shortage is about to be exposed. I am monitoring the inventory data at COMEX and LBMA closely. There are signs that we are scraping the bottom of the barrel. If you want to receive an early warning alert when the physical squeeze signal officially triggers, comment "Gold Squeeze" below. Remember, in this game, you cannot use policy to fight math, and the math is on gold's side.